I guess essentially I wrote an article on our website titled "The Mining Money Trail: Junior Mining Financing Heats Up in 2025," and I covered specific service companies which could benefit and used some real world examples, such as drilling companies. We do have two other drilling companies that we like within our coverage, but I did cover major drilling in this article, as well as I covered it on the podcast last week. There's also engineering firms, such as like Eagle Plains Resources, for example, which I've covered on the podcast in the past. Now, it's not a pure play engineering firm, but it does own Terralogic Exploration, which essentially is generating 100% of the company's revenue. It isn't, a company which screens very high for us, as it's not profitable, but it could benefit from an uptick in financing for juniors. And of course, last but not least here, equipment and logistics providers such as Toromont, which is an equipment provider. So I thought that I would do a review on the business today, since the last time I covered it on the pod was about a year ago. So Toromont Industries Ltd, TIH on the TSX, currently trading at a price of about $165 per share, $12.8 billion market cap, and a dividend yield of about 1.3%. So they provide specialized capital equipment in Canada, the US, and internationally, and they operate in two segments. It's Equipment Group and CIMCO. The Equipment Group segment engages in the sale, rental, and service of mobile equipment for Caterpillar and other manufacturers. And the CIMCO segment is involved in the design, engineering, fabrication, installation, and after sale support of refrigeration systems in industrial and recreational markets. And at the last quarter, over 88% of revenue came from the Equipment Group segment. So that is primarily most of the business. Now, as I noted, the last time I covered the stock was about a year ago, when it traded in the $125 range. At that time, I said that I wouldn't bet against Toromont long term. They've grown the dividend very well, great long term growth, and the stock has performed quite well since then, driven by strong financial results, with the stock up 47% year to date. And again, impressively, the company is really a dividend aristocrat, having grown its dividend consistently for the past 35 years. And that payout ratio remains healthy, which I'll go over in the conclusion at the end. Now, let's look at the financial results, which have been driving that share price higher, as well as those dividend increases. So looking very long term, we can see revenue has had a positive trajectory since 2015 and has grown over the last 9 years with a compound annual growth rate of about 12%. They do make acquisitions, so keep that in mind. But most impressively, net income has grown with a compound annual growth rate of 15% over that same period. Now, looking more granularly at the most recent quarter for Q3 of 2025, ended September 30th, 2025, revenue was actually down 2% to $1.31 billion and was driven by lower revenue in the Equipment Group, partially offset by strength in CIMCO. And net income was $141 million approximately, or $1.73 per share, which is up 8% from a gain of $131 million, or $1.60 per share in Q3 of 2024. Now, I also wanted to highlight that there is seasonality in the business, with the equipment segment posting its weakest quarter in Q1 due to winter shutdowns, while Q4 tends to be the strongest quarter, as it coincides with the timing of customer capital investment decisions. Looking at the balance sheet, it's always had a quite a nice balance sheet, which is why I've liked the business. Net cash position of about $217 million. And the business has been buying back shares slowly and steadily. Looking at the backlog, it is up 15% year over year to $923 million from $803 million, while bookings were up in Q3 by 49% compared to Q3 of 2024 year over year. So bookings and backlog certainly remain robust at this time. Looking at the trailing valuation, the stock trades at about 28 times trailing earnings. The last time that I covered the stock, it was at about 20 times earnings. And if we look at its primary comparable, Finning International, Finning is currently trading at about 20 times earnings or 20 times trailing earnings. So, comparatively, Toromont is more expensive, but I will note that Finning has posted weaker long-term growth and has a significantly worse balance sheet. It's still sustainable, but I just love the cash-rich balance sheet that Toromont has. And looking long-term here at the bottom of the screen, the median trailing price to earnings ratio for Toromont is 20 times over the past decade. So right now, the business is trading at a premium, looking a little bit pricey in relation to its historical multiple. So to conclude, Toromont is a solid dividend aristocrat, having grown its dividend for 35 years consecutively and only pays a payout ratio of about 33%, so it can continue to support dividend increases. The company has a solid cash-rich balance sheet and robust backlog. Bookings are also strong right now as well. Compared to peers like Finning International, investors must pay up essentially at 28 times earnings for Toromont. But seeing the better balance sheet and history of growth, I certainly see why the business trades at a premium. But I will say Toromont is currently trading above its 10-year median price to earnings multiple of 20 times. So right now, I believe that the business is maybe a bit more on the pricier side. Now, if someone was looking to hold Toromont in their portfolio long term, I think that it's a solid business. They might potentially benefit from more activity in the junior financing space, but right now, I would be a bit cautious paying the elevated valuation for the business. Now, another thing that I didn't go over, but I'll just quickly mention at the end here. On January 31st, 2025, the company did acquire 60% of the shares of AVL Manufacturing Inc., which is a leader in the design and fabrication of power generation and storage enclosures, for consideration of about 67.5 million cash, plus the issuance of about 110,000 Toromont shares. Now, the company has committed to purchase the remaining 40% at various dates through to 2031. So they will be acquiring the rest. But at the time of the acquisition, AVL had operations in Hamilton, Ontario, which has now subsequently expanded to the US. They acquired a facility in North Carolina for approximately $60 million to expand capacity to serve the Eastern US market, with the first phase of production during the Q3 or expected during Q3 of 2025. So, right now, I like the business long term. I just think that, near term, I'd be a little bit cautious paying the elevated valuation multiple compared to its historical multiple.
Yeah, I think it's a good assessment. I mean, I think it's a quality business. I think the dividend growth has been strong, and I think you're right. It trades at the premium end of its multiples. If it was a pullback, this is the type of company that we'd be looking at to add.
Yeah. Yeah,
Yeah,
certainly.
all things being equal.
Mhm.
Yeah, I mean, if
Yeah, if all of a sudden,
6 months
the
from now, like
backlog.
clients always ask, what would you add at what price?
Yeah.
Well, we can't say a price because there might be a reason they fall 30% and then they're not a buy at that price. And it could go up 20% and be a buy too.
Yeah.
So, because something could change, they could double earnings and only go up 30% and then they're a buy, right? So, clients are always like, oh, what's the entry price? Well,
Yeah.
we will see what the valuation is if it drops or
Yeah.
if it stays in the current range. It could stay in the current range and become a buy in a year if they grew earnings. So there's
Yeah.
it's not just price you look at when you look at, and that's why, when we get, what is the price? What should we buy at? If today we can tell you, but by the time it gets to that price, it may
Mhm.
be a different financial picture that we're looking at.